Order Flow Trading Course Lesson 3, How to Read Order Flow Charts. First, I'll read a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Oftc Rules 4.41 state, hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. Okay, let's begin. Lesson 3, How to Read an Order Flow Chart. An order flow chart allows a trader to see volume traded on the bid and the volume traded on the offer. You can use range charts, minute charts, Renko charts, whatever type of chart you are comfortable looking at, order flow can be applied to it. Whatever time range you look at, you can apply to it. It doesn't necessarily have to be, a 1 minute chart, a 5 minute chart, a 5 range chart, a 10 range chart. You can look at point and figures, you can look at Renko charts. Whatever chart you're comfortable looking at and you're currently using, you can apply order flow to it. That said, the chart should be on an intraday basis. Looking at an order flow chart on a daily basis is kind of, I don't say useless, but I haven't found any value in it. You want to see the order flow as it's coming in. If you're looking at a daily chart trying to discern the order flow, it's a mess because you're basically trying to follow the order flow, but on a daily chart, you're just seeing a big dump of data. When you spread it out over, you break it down over the trading day, that's when it's most powerful. So what does an order flow chart look like? Well, when reading an order flow chart, you compare price on the bid against the offer diagonally, not horizontally. So you're comparing the 686 against 12. It's what traded, not the bid and the offer. The market's always going to have a bid and an offer. What you want to do is compare the relationship. Again, what's important with order flows is you want to compare traded volume, not volume in the book. So when you see a footprint chart, it's the volume that's actually traded. Why is that important? Because that is what how people commit themselves to the market. When you work a bid and an offer and you're not getting filled, you're not committed. When you trade, you're committed to the market. You have a position. So remember, there's always a bid and offer in the market. That's how trading is conducted. Here you have the market 913.25 bid, 913.5 offer. The size on the bid is 280. The size on the offer is 565. If you want to buy at the market, you buy the offer. So in this case, you would buy it at 1913.50. You are considered to be aggressive. If you want to sell at the market, you sell at the bid. You are being aggressive as well. Whenever you go to the price where the market is bid or offered, you are being aggressive. If you're joining the bid or the offer, then you're being passive, which if you are content to let the market come to you, then you'd work a bid if you want to buy or an offer if you want to sell. This is considered passive buying or selling. When you're working a bid to buy or an offer to sell, there's no guarantee that you'll get filled, even if price trades at the price you are working at. So order flow charts monitor not just the volume and price, but which side of the market the volume that traded occurred, the bid side or the offer side. So here you see a picture of the market depth. So you see there's 280 on the bid, there's 565 on the offer. The market is currently bid 913.25. It's currently offered at 913.5. Below the bid at 913 even, there's 722 lots. Above the offer at 913.75, there's 893 lots. If you are working a bid, if say you're trying to buy it at 913.25, and you're on the bid, you're part of the 280 lots there, you're considered a passive buyer. If you're trying to sell at 913.50, you are on the offer at 1913.50. You're part of that size of 565 there. You are a passive seller. If you get tired of waiting on the offer at 1913.50, you move your price down to 1913.25. You are being aggressive. You are going to the buyer's price where they're sitting on the bid. So the guy that's sitting on the bid, he's passive, but you moving your price down from 1913.5 down to 1913.25, you're being aggressive. You're the aggressor. A common problem that many losing traders face is they focus purely on technical indicators which lag the market. Indicators are derived off of price and are based on what the market did in the past. Consistently profitable traders don't lag the market. They don't get into the trend at the end of the move. They get in at the beginning of new trends. And what order flow will do for you, it'll help you determine when the trends are beginning, and it'll help you also see when they end, but it's not telling you to get in at the end because you'll know that it's ending, and if anything, you can tell that if the market's going to go sideways or a new trend is going to happen. Okay, here's an order flows chart. Now, just real quick, one of the things I want to talk about is most traders that are generally unsuccessful, they have a habit of following price. They use indicators which follow price. It's based on price. The market has to open and close at a price. But when you start to do that, you tend to think all prices are equal. When the market gets to a level, it trades the price, and it's not much different than when it traded the price before it. But however, price is not all prices are equal. Each price level has its own character on what happened there, and order flows will help you determine what that character is, what is happening in the market, and why it's stopping. You have to be able to determine if what traded at a price is a shift in supply and demand or weakness, and order flow will help you determine that. Now, like I said, here's a chart, and you see, you hit a high, and I'll get into what all these blue numbers and things mean, a bit later. But what's important is you're seeing that market come up to a high. If you can be alerted to hey, that this is a turning point up here, based on what's happening with the traded volume, that's what you want to know. You don't want to, if you're following some sort of oscillator or something, it's going to turn, it's going to come in here and sort of come down. But if you could be alerted up near the high that there's a change in, from demand to more supply, that's where you're going to make your money, because you're going to get all of this area in here, these extra points that you could be selling at rather than selling at after the market's already turned and started its move lower. Okay, so, again, not all prices are created equal, and you have to understand what's happening when the market trades a price. What order flow does is it tells you what's traded on the offer side, what's traded on the bid side. And there's going to be times you're going to see where buyers overwhelm the sellers, or market's moving so fast that, the buying is frantic. You want to be able to pick that up, pick up these times when, buyers are being overly aggressive. Like you see here, you're seeing buying imbalances on the way up. You're seeing these zones, and the market just shoots right up. It retraces back into these levels and shoots back up. Lots of times as a trader, you want to, you see the market is fluctuating up and down, and, one bar retraces to a certain level in the previous bar and turns around. Why? These are questions, if you can answer, will make you a better trader. And that's what order flow does. It helps you answer those questions. Why did the market retrace back to this level here? Why did this market come back to this level here? These are questions that order flow will help you to answer. Before in the past, nobody could really have a firm answer, back before computers. When you're just looking at individual bar charts, it was a lot more difficult. Now with the advent of computers, it's a lot easier. What order flow will help you see is when you see what looks like buying early, but it can't follow through, and then it changes and sells off. It's alerting you to these things that you're not going to ever see in a normal bar chart, because bar charts generally do not look at volume at all. And volume is a big part of trading, especially traded volume. There's a lot of products on the market, that are dome related, that deal with, looking at the depth of markets and, what's behind it and all that. But that's not actual commitments of trading. All that is just, people's intentions. Once the trade happened, then people are committed to the trade. So you're going to see areas where volume, bulges out, or areas where there's aggressive buying and it can't follow through, and then the market starts coming off. These are areas where, as a trader, you want to take advantage of. Now, there's one important note with order flow. For me, I find it extremely important to wait until the bar closes before taking a trade. So, what I'm trying to say is, again, don't enter a trade while the bar is still forming. A seemingly bullish bar on an order flow bar can turn into a bearish order flow bar very fast. Be patient. One of the most common mistakes in trading is being too eager with an itchy trigger finger on the buy or sell button. Sometimes, when you're watching an order flow chart develop, a footprint chart, and it looks like it's going to be a very bullish bar, but you should really wait for it to close. I mean, we all want to catch a move early, and you think, well, it looks like this bar is about to close. I think I could get in and, get a couple extra ticks out of it, rather than waiting for the bar to close, have confirmation that, the bar is indeed what it is, and get in a couple ticks later. I know I've struggled with that in the past. I've always wanted to be the first one, to show up and the last one out, but, you're going to run into problems. I mean, 90% of the time, when a bar is really near completion and you think it's going to be complete, it will be, but it's those 10% of the times where it can just change on you. Here's an example. What to do. Okay, you have this bar here, this red candle, on both charts it's the same, but this bar here is developing, and you're thinking, hey, I've got some stopping volume at the bottom here. The bar is green. I want to get in. I want to catch a move. We're going to go higher. Well, what happens a few minutes later? You're still in the same bar. It hasn't completed. Now it's turned negative. And instead of having the ratio on the bottom, you have a ratio on top indicating stopping volume on top, whereas earlier you had stopping volume on the bottom. And what happened? This is how the bar ended up. The bar sold off, opened up the next bar, and sold off another 2 or 3 points. So, that's the end of lesson 3. In the next lesson, I'll explain the terms used with order flow. So by then, you should be able to understand, the charts a lot easier when you hear me talking about the charts and using certain terms. But, just to go back a second here, I just want to spend a little bit more time and talk about the order flows chart. What you're looking at, right, it's a footprint chart. It's a footprint of what traded. 3 lots traded on the bid here against 122 when it was offered there. 174 against 265, 150 against 816. Now the bar can move up and down. Like I said just now, wait for the bar to close before determining if it's an up bar or a down bar. Because, the bar can go up and down, up and down, up and down over, a period of time, because that's what the market does. It trades, it facilitates trade. So the market is going to go up and down. Eventually it's going to end, on one end or the other. And the market's going to go higher, it's going to go lower. So, what you want to see is what it looks like after it's formed. When it's sort of in the middle of forming, it's not complete. It's not a complete picture. It's only a partial picture. That's why you should wait for the bar to close. And, and understand you're looking at price horizontally, not diagonally. The only time you're looking at price diagonally is when you're looking at the point of control, which is this box. But, we'll talk about that later. But what's important is you're comparing price, what's on the bid versus what's traded on the offer. Why is that important? It's because, the market doesn't trade at one price. It trades, there's a bid, there's an offer. So someone's going to sell into the bid or they're going to buy the offer. And that's what you want to see. You want to see the actual traded volume, not just the depth of the market that, maybe there's, when you're down here at 190025, maybe there was 500 lots on the bid, but there's actually only 3 people, 3 lots that traded to commit to that price. Whereas, when it was 1950 and a half offered, maybe there was 250, but people were interested in buying it. As people started buying it, the people that were selling it probably moved their offer back up to, 00.75. What's important is it only traded 122. You can read and you'll start to learn how to read the numbers as you go along in this trading course. So that's the end of lesson 3, and as I said, we'll pick it up in lesson 4 when you're ready. Thank you.